Hello, welcome to Chapter 4. Today we're going to talk about cost accumulation, tracing, and allocation. This chapter is going to be split up into several videos to reduce the length of the videos. So basically in this chapter we're going to talk about how to cost our products. So why do we care how much it costs? Well, we need this information in order to be able to price our products, evaluate performance, control operations, and prepare our financial statements. First thing we're going to do is talk about the difference between cost objects and distinguish between direct cost versus indirect cost. This is an important concept that we're going to talk about for the rest of the semester. So a cost object is any activity, product, or service to which we want to trace the cost. So first we need to identify the cost object, and then we need to identify the cost driver. The cost driver is any factor that causes or drives an activity cost. For example, if you had costs of gas for your car, the miles that you've driven is what's driving up or down the cost. For example, if you're making a product that's machine intensive, the cost of that product is probably going to be driven by the amount of machine hours that you're working to make that product. Labor hours and units produced are another example of this. So an example is when you're looking at a call center or talking on the phone. So on this axis you'll see the long distance telephone bill, and here you'll see the minutes of the minutes talked. The more you talk on the phone, the higher the price is going to be. So the cost is actually equal to the minutes talked times the rate per minute. So minutes talked is the cost driver, and then you calculate the rate per minute to calculate your total cost. Once you've identified your cost objects and your cost drivers, you can begin to allocate those costs. This is applicable to when you're talking about indirect costs. Let's look at an example of identifying direct and indirect costs. So here we have a company that sells women's, men's, and children's clothing. It's a department store. So management has decided to base future bonuses on department profitability, and you can see there's 3 different departments. The first step in the development of the new bonus strategy is to determine the cost of each department. Costs that can be traced to the departments in a cost-effective manner are called direct costs. Costs that cannot be traced to the department in a cost-effective manner are called indirect costs. Examples of direct costs are typically your direct materials and your direct labor. Anything that is indirect is referred to as overhead. So here you could see the direct costs. We have cost of goods sold, sales commissions, supervisor salary, and depreciation. Those can be attributable easily to each individual department. Then we have the store manager salary. The store manager is in charge of the entire store and all 3 departments. We have the rental cost for the store, the utilities, advertising, and supplies. So we can't easily trace those to the specific departments that are using them. Here is where we're going to introduce the concept of cost drivers and allocating these costs between the 3 different departments. So first we need to identify what the most appropriate cost driver is for the cost that we're looking at. So going back to this example, we're going to look at each of the costs and figure out what makes sense in terms of a cost driver. For example, store manager salary is going to be portioned equally between each of the departments. If the manager spent a larger proportion of his or her time in one specific department, then that department would get more of the cost. But here it's spread out equally. Store rental. So the rent is typically based on a per square footage amount. So you would use square footage. Same for utilities. You can calculate how much utilities to allocate to each department based on the square footage that each department takes up. And then advertising and supplies, you could use the sales volume. So how much of the total sales each department has. In order to allocate the costs, we're going to use a 2-step process. First, we need to calculate the rate at which we're going to allocate the cost, and this is taken by the total cost divided by the cost driver activity. So for example, when we're allocating the store manager salary, we're going to take $9,360. In this case, we're just dividing it by 3 because there's 3 departments. But in order to divide the store rental space, we're going to take the 18,400 and divide it by the total square footage of the store. So we need that information. Once we have the rate, we're going to take that rate times the weight of the cost driver. So once we know that rate, we're going to multiply it by the amount of square feet for each department to get each department's specific costs. So here's what that looks like. That's the store manager salary split equally. Here we know that the total square feet they've given us is 23,000. 12,000 is women's, 7,000 is men's, 4,000 is children. Therefore, we're going to take the total cost of 18,400 divided by 23,000 square feet to get a rate of 80 cents per square foot. Then we can take this rate of 80 cents and multiply it by each department's square footage. So 12,000 for women equals 9,600, 7,000 for men is 5,600, and 4,000 for children is 3,200. The total of each department needs to equal the total cost that you're allocating. Here's the example for utilities. I'm not going to go through these in details because the slides are available to you and it's the same process each time. Advertising is based on sales dollars of 360,000 total, and supplies is the same measure. So here's what our new income statement looks like after we've allocated the indirect cost to each department. So you could see that the children's department is the least profitable with $4,130, then the men's department at $25,405, and then finally the women's department is the most profitable at $30,305. So using volume measures to allocate variable overhead. Increases in the volume of production will cause variable overhead costs to increase. So volume measures can be good cost drivers for the allocation of variable overhead, but you have to make sure that you're using the right volume, whether it be units produced, labor hours, or materials used. Excuse me. Here, we're looking at a furniture company. So we're going to use the two-step process again to allocate the indirect materials cost, and we're going to look at the scenario under 3 different volume measures. So you can see how, depending on what cost allocation driver you use, you can come up with very different results. So if we're going to use the number of units, we're trying to allocate the 60,000 of indirect materials between chairs and desks. So if we're using number of units, it's a total of 5,000, gives us $12 per unit, and then the $12 per unit times 4,000 chairs, $12 per unit times 1,000 chairs allocates the cost as such. If we're going to use hours, it's going to be $10 per hour, and we multiply it by each product's number of hours. And then finally, let's see what it looks like when we use the $1.5 million of direct material. So you can see here that the total is always going to be 60,000, but dependent on the allocation cost driver that we use, we could end up with very different results. When we're using units of production, our chairs cost a lot more than our desks. But if we're using direct materials cost, our desks end up costing a lot more. So which volume measure should I use? Judgment and reasoning are necessary. You need to consider the relationship between the cost driver, activity, and the use of resources, and then the availability of the information that you have at your fingertips. When we're allocating fixed overhead costs, we need to distribute a fair share of the overhead costs to each product. There are no volume-based cost drivers for fixed overhead. So what does that mean? Let's look at another example. Here we have fixed rental cost of $28,000. Again, we're going to use the two-step process to allocate the fixed rental cost to units sold and to units in ending inventory. So we're going to use units produced. $28,000 divided by 2 million units is 0.014 per unit, times 1.8 million units sold, and then times 200 units still in ending inventory. I'm going to pause the video here and start a new video for the rest of the chapter.